Welcome to Breaking News to Trading Moves.
Good to be here.
Today we're looking at a recent financial outlook from Intel. It's giving us a pretty clear map of the semiconductor market right now.
It really is. It's a perfect example of how a single supply chain issue for one company can change the math for everyone else. Competitors, suppliers, you name it.
Okay, so let's start right at the top.
Yeah.
The headline. Intel, that's ticker INTC, they released their Q1 outlook.
And it was, well, weaker than the street was hoping for.
Weaker how?
Both sales and profit guidance came in below estimates. And, when a company that big guides down, the shares react. They drop pretty sharply in after-hours trading.
Let's get into the specifics. What were the numbers they actually gave?
For the first quarter, revenue guidance is between $11.7 billion and $12.7 billion. That's below what most analysts were projecting.
And the profit side?
The adjusted EPS, earnings per share, is guided to be just about break-even.
Break-even. That's a tough number when the rest of the sector is all about growth.
So what was the reason? Management said something that sounded a bit strange at first.
They did. They said their factories are running at full tilt.
Which sounds like a contradiction, right? If you're running at full capacity, shouldn't revenue be great?
You'd think so, but the issue is a mismatch.
A mismatch between what?
Between what their factories are set up to build and what the market is demanding right now. The demand has just moved so aggressively toward AI server CPUs.
So they're making bread, but everyone wants donuts.
That's a good way to put it. The constraint is specifically on those server CPUs for AI data center builds. This isn't about laptop chips, it's the heavy-duty stuff.
I think we should clear something up here. When people hear AI data center, their mind immediately goes to GPUs, to the accelerators.
That's the common story for sure. But you can't just have a room full of GPUs. A data center is a whole ecosystem. You need a CPU, a central processing unit, to be the host.
It's the traffic cop. Precisely. It manages everything, directs the data to those accelerators. If the traffic cop isn't there, the intersection is just a jam.
So if Intel can't deliver that CPU,
the customers, the big cloud providers, can't just wait. They have deployment schedules.
And that leaves them with two choices. Delay the whole project, which is bad for business.
Or substitute. Look for a different architecture, a different supplier to fill that slot.
And that one decision to substitute is what creates the winners and losers here. The money doesn't just vanish.
It rotates, and we can basically follow it.
All right, let's do that. Let's start with the winners. If I'm a buyer and I can't get an Intel server CPU, who's my first call?
The most direct alternative is Advanced Micro Devices.
Ticker AMD.
Correct. AMD has its EPYC platform. It's the direct competitor. So if Intel supply is tight, orders naturally rotate over to AMD.
So they're the first beneficiary.
The first, yes. But there's another angle. Some customers might look beyond that whole architecture. This kind of situation really helps the case for ARM Holdings.
Ticker ARM.
Yep.
ARM's architecture lets these companies design their own custom chips. So if the standard supply from Intel is unreliable, it gives them more reason to say, you know what, let's just build our own with ARM.
It pushes that custom silicon trend forward. Okay, that's the CPU. But you said these are complex systems. What about the other parts?
That brings us to our second category of winners, the AI networking and custom silicon enablers.
Okay, break that down. Why would networking companies win from an Intel supply problem?
Because the build-out of the network itself, the switches, the interconnects, that all has to continue. And in fact, if you start mixing different CPU architectures, the networking part becomes even more critical.
More complex, so you need more sophisticated gear.
Exactly. The first name there is Broadcom.
Ticker AVGO.
Broadcom helps companies build their own custom silicon, and they provide the high-speed switching that connects everything. If you move away from a standard Intel rack, you're often moving toward a custom setup where Broadcom plays a much bigger role.
Who else is in that group?
Marvell Technology.
MRVL. Marvell is big in optical interconnects and custom compute. The thinking is that the hyperscalers keep spending on their AI fabric, the data center's nervous system, even if the CPU gets swapped out.
The infrastructure spending just keeps going. What about the most basic components? Every server needs memory and storage.
And that's the third winner category, the memory and storage play. AI servers are just incredibly hungry for both. Huge amounts of DRAM, tons of storage.
And it doesn't matter if it's an Intel or an AMD chip. You still have to buy the memory.
Exactly right. That capital spending doesn't go away just because the processor vendor changed. The motherboard slot still has to be filled.
So who's capturing that spending?
You start with Micron Technology.
Ticker MU.
Micron is a key supplier for the high-density memory these servers need. And then for storage, you have Western Digital.
WDC.
Right. As long as the AI build-out keeps going, which it seems to be, suppliers in memory and storage just benefit from the sheer volume. Doesn't really matter whose logo is on the CPU.
So just to recap the winners. Demand shifts to AMD and ARM for processors. It reinforces the need for Broadcom and Marvell in networking. And it keeps demand steady for Micron and Western Digital for memory and storage.
That sums up the rotation pretty well.
Okay, now we have to flip the coin. Let's talk about the losers. The most obvious one is, well, the company at the center of it all.
Intel itself.
Ticker INTC.
Yeah, the weak guidance is a direct hit. It's a clear impact on their revenue and margins for the quarter. There's really no other way to see it.
But there's another name on this list that might confuse people. When you think AI, you think NVIDIA.
Ticker NVDA.
Right. And seeing them on a losers list feels wrong. Demand for their GPUs is through the roof.
It is. This has nothing to do with demand for their products. It's a timing issue, a logistical one.
Explain that.
It goes back to what we said before. You can't deploy an NVIDIA GPU without a host CPU.
It's like having a race car engine but no chassis to put it in.
That's the perfect analogy. If Intel can't ship the CPUs, the server racks can't be finished. So those NVIDIA GPUs might just sit in a box for an extra month or two.
The revenue gets lumpy.
That's the term. The revenue isn't lost, but it might get pushed from one quarter into the next. And for the market, any kind of delay can be seen as a negative, even if the long-term story is still strong.
So it's a headache, not a fundamental problem for them.
Correct.
Okay, let's move on. Someone has to actually assemble all these parts. The server builders?
The server OEMs and integrators?
And the logic here seems pretty simple. If you're missing a key part, you can't ship the final product.
It's a classic supply chain bottleneck. Your assembly line has everything else, but you're just waiting on that one CPU. You can't finish the build.
Which means you're not getting paid.
Not recognizing revenue, and you're holding all that inventory, which costs money. You can't bill the customer until that server is out the door.
Who are the main companies getting caught in this?
There are 3 to watch. First, Dell Technologies. Then you have Hewlett-Packard Enterprise.
HP.
And Supermicro Computer.
SMCI.
All 3 of them depend on a smooth flow of components. A constraint on a major part, like an Intel CPU, just jams up their whole process and puts pressure on their near-term guidance.
That makes sense. Now, there's one more group here, and they're another step removed from the final product. The companies that make the machines that make the chips.
The semi-capex tools providers.
So help me understand this. If Intel can't make enough chips, wouldn't they want to buy more equipment to expand capacity? Why are the equipment makers on the loser list?
That's a logical question, but corporate finance in a tough quarter works a little differently. When Intel issues weak guidance, it means they're under margin pressure. Cash flow is tighter.
So they tighten the belt.
They tighten the belt. And one of the quickest ways to conserve cash is to delay big capital expenditures, like buying new manufacturing equipment.
So they might just push a big order back a few months.
Exactly. They wait until they have better visibility into their own sales. And that pause creates uncertainty for the tool makers.
Who are the big names we're talking about here?
You've got Applied Materials,
Ticker AMAT.
Lam Research,
LRCX.
and KLA.
KLAC.
Right. Their order books are directly tied to the spending budgets of the big chip makers. If Intel pulls back, it's felt almost immediately.
Okay, so to sum up the other side, Intel and NVIDIA face direct hits or timing issues. The server builders like Dell, HPE, and Supermicro get stuck with assembly delays. And the tool makers like Applied, Lam, and KLA could see orders get pushed out.
That covers the main risks.
So looking forward, what are the key things to watch? This is a Q1 issue, but it could last longer.
There are a few things. First, just watch the supply situation after Q1. Intel itself suggested this quarter is the tightest point.
So we see if it's a temporary problem that gets fixed by the spring.
Right. If supply starts flowing again, the pressure on everyone else eases up quickly. If this drags on, though...
Then delays start to look more permanent.
Exactly. Second thing is Intel's own tech roadmap. Keep an eye on their next-generation manufacturing nodes. They call them 18A and 14A.
The new technology that's supposed to get them back on track.
Yes. We need to see if those are on schedule and if they can get external customers to commit to using their factories. That's a huge signal of confidence.
And what's the last thing?
I think the big question is whether AI server demand is so strong that competitors capture market share immediately because of this.
That's the real strategic point. Because once a customer switches,
It's sticky. Very sticky.
if a cloud provider is forced to design a server around an AMD chip today because they can't wait for Intel, do they ever switch back? Or have they just found a new default supplier?
That's the long-term risk for Intel. A short-term supply issue could lead to a longer-term loss of market share. If that share walks out the door now, it might not come back easily.
So the immediate story is about a production bottleneck, but the bigger one is really about market share. It's definitely a situation worth keeping a close eye on. And just a quick reminder for everyone listening, this is our analysis of the news.
It is not financial advice or any kind of buy or sell recommendation.
This is purely the opinion of the author.
Please do your own research.
Thanks for joining us on Breaking News to Trading Moves. We'll catch you on the next one.